What is debt financing? Debt financing is all about raising money for a business by selling debt instruments like bonds, bills, or notes. It's like borrowing money but in a more formal, business-wise way. You get cash from investors, either big institutional folks or everyday people, and in return, you promise to pay them back with a little extra interest on top. The cool part? You don't have to give away any ownership in your company, so you get to keep all your shares. Yay, it's popular with startups and small businesses because it lets them get the funds they need without selling equity. If the business does well, the profits all come back to the owners without having to share it with outside investors. Now, how does it actually work? A business issues some form of debt like a bond, and investors buy it. The company agrees to pay them back, usually on a set date, with interest. If things go south and the company goes belly up, the lenders, the ones who bought the debt, get dibs on whatever assets are left before the shareholders do. Measuring debt financing isn't rocket science, but it's important to keep track. Businesses usually look at things like the cost of debt, that interest you pay, it's tax deductible, so yay for savings. They also check out the debt-to-equity ratio, which compares how much of the company is funded by debt versus shareholders' money. Then there's the interest coverage ratio, which tells you how many times a company's earnings can cover its interest payments. Pretty handy for banks deciding if they want to lend money. Debt financing has its perks. First off, you keep ownership, which means no sharing your business pie with others. Plus, since interest payments are tax deductible, it might be a cheaper option. It also helps with planning, because you know exactly how much you'll have to pay every month, making budgeting a bit easier. But it's not all sunshine and rainbows. You'll need to meet certain criteria, like having a decent credit score, to qualify for loans. It also requires discipline to make those regular payments on time, no slacking off. And sometimes, you might need to put up collateral, which could be a personal asset. That's where things get a little risky, especially if things don't go as planned. So, yeah, debt financing can be a solid option for raising capital, but it's important to weigh the pros and cons before diving in.